Hello! I wanted to welcome everyone to today's webinar entitled How to Prepare for the Biden Tax Increase. My name is Kevin Daniel and my company is the Daniel Financial Group. I feel that education is the most important thing that someone can have in order to make the right decisions. So, I am going to present a new webinar. I'm going to try to do them every month, starting this month for the foreseeable future. And my whole goal is to help present things month to month that will help you make better financial decisions. Today, we have a wonderful presentation. It's going to be quick, but it's going to have some really, really good information, and I think that you're going to find a lot of value. So, without further ado, let's get started. Now, I wanted to give a quick warning. This is not a political discussion, but this is basically a discussion about potential changes to the United States tax code. This is for educational purposes only. If you see some information in this presentation, I highly recommend that you seek the assistance of a professional advisor before you make any decisions based on the information received on this presentation. So, if you don't mind, I'd like for you to try to be in a distraction-free zone. I'd like for you to turn off your phone, close your door, click out of any other windows. We don't want any distractions. And I would recommend that you take a couple of notes, because I feel that the content, even though it's kind of short, it's going to be very heavy. And this again, this is not a political presentation. This is for information only. And again, I highly recommend you seek professional advice before you act on what you see today. And again, I also want you to focus. But, why is this so important? Well, because today we're starting to hear rumbles that, well, there might be potential tax increases. So that's what we're going to do. We're going to review those possible tax code changes that could happen before the end of this year. We're going to take steps that you can take now to help prepare yourself. And then I'm also going to show you the next step, if you need any kind of help. So who is this presentation for? Well, this presentation is for for a lot of different people. Well, it's for people that are working. It's for people that have money that are inside of 401k, 403bs, or IRAs. That's really one of the main people that this presentation is for, because if you don't know it by now, if you have money sitting in a 401k, a 403b, or an IRA account, basically the federal government, they have a tax lien on all of that money. I hope everybody realizes that. So if tax rates go up, well, you'll have less money in those accounts when you start to withdraw. That's why this presentation is important. This is also for anybody that has money invested in a brokerage account, that has individual stocks or, that sort of thing. It's also for people that are concerned about outliving their money. So here's the current tax code as it stands today. Today, the top individual tax rate is 37%. The top business tax rate is 21%. Currently, we have a long-term capital gains rate of 20%. The current estate tax is $11.7 million. Now, a lot of people don't understand what the estate tax is because the number's so high, and a lot of people really don't have that much money inside their estate. But back in the day, the estate tax, reach was much lower, and actually it was as low as $600,000. Anybody that had over $600,000 way back in the day, well, they were charged 40% once they passed away. And we're going to go over that today because I have a feeling that that has a big, that's a big possibility that changes. I don't know how much it's going to go down, but that's definitely something being considered. We're also going to go over proposed changes. So here is the proposed changes that we're hearing in the news today. We're hearing that the corporate tax rate could rise from 21 to 28%. We're hearing that the tax preferences for so-called pass-through businesses like LLCs and partnerships. S-corps would also fall into this category. They're talking about they're going to limit, some of these benefits and the tax preferences, especially on S-corps. They're also talking about raising the income tax rate on individuals earning more than $400,000. They're talking about raising it from 37% to 39.6%. And like I said on the earlier slide, they're talking about taxing smaller estates. So that 11.7 number, that's for one person, a couple, it's at 23.4 million. I have a feeling that that's going to go down dramatically. Again, these are just proposed changes. Nothing's happened yet. They're also talking about implementing a higher capital gains tax rate for individuals earning at least $1 million annually. Biden on the campaign trail proposed applying income tax rates, which would be higher. The current top rate is 20%. 15% if incomes are under $469,000. Again, that's for long-term capital gains. The short terms are different. So those are the proposed changes that we're hearing in the news today. And this is the reason why it's important to consider what I'm about to go over. Because if this happens, it would have been in your best interest to act now. But here's my concern. I'm worried this might not be enough. Here's why. In 2020, the federal government ran a deficit of $3.1 trillion in 2020. That was more than triple the deficit for 2019. This year's deficit amounted to 15.2% of GDP. That's the greatest deficit as a share of the economy since 1945. Why? Well, COVID really threw a monkey wrench in things last year, and quite honestly, it doesn't look like we're not going to be able to grow the economy in the current situation to get us out of this mess. Here is our current national debt. If you want to see something shocking, log on to www.usdebtclock.org and watch that debt clock spin. It's amazing how fast we're racking up debt. And that's why proposed changes, I feel, are needed, unfortunately. We also have an aging population. 10,000 people turn 65 every day. So what does that mean? More people are using, Social Security, Medicare, and Medicaid. That's another big problem. More people are, the baby boomers are retiring. Other possible changes. They're also talking about possibly putting a tax on assets. That's something that Elizabeth Warren's talked about. They're also talking about not being able to fully deduct 401k contributions. Currently, everything you contribute, it's tax deductible. We're talking about lowering that possible. They're also talking about adding a value-added tax. They're talking about, and now the next one is just I think would be a good way to get extra tax money, and that would be to change the required minimum distributions. Does everybody know what required minimum distributions are? Well, required minimum distributions are basically when you have money in a 401k or an IRA, 403b. Well, once you hit the age of 72, the government forces you to withdraw money, and they call it an RMD. That's basically them forcing you to take money off of your retirement account. So currently now, that age is 72. So when you get 72, you have to pull off roughly 4% of the account balance. I think that they could easily make an adjustment there, and it really wouldn't cause a major problem to most people. Again, that's just other possible changes. They're also talking about possibly taxing 100% of Social Security benefits. Currently, you can only be taxed up to 85%. I have a feeling that's a strong possibility. They're also talking about raising payroll tax to 100% of wage earnings. Currently, you're only taxed on your first $120,000 these days. They're talking about possibly taxing 100% of your earnings if you make more than $120,000. So as you can see, there's a lot of possible changes into the tax code, and that could happen at any time. So what can I do about it? That's what I imagine you're sitting there thinking to yourself, or what you should be thinking. Well, today we're going to go over several different strategies that can help you. The first thing we're going to go over is the Roth IRA conversion strategy. Something else you can do about it is you can stop the bleeding now, currently, possibly, on your 401k at work. If you have a 401k at work, I would recommend you call your human resource department and see if you have the ability to switch basically from a 401k to a Roth 401k, just to see if it's available. If it's available, it's something that you want to consider, and basically that means that you're paying the tax now on those accounts. So if you have a Roth 401k, you pay the tax now. It grows tax deferred, and then tax-free, and then when you withdraw it, it's tax-free as well. So the Roth account is the best account that you could possibly be in these days. You could also establish an A and B trust to shelter assets from estate taxation. We'll go over that in a moment, but you remember I was telling you about the $11.7 million for a single person, $23.4 million on a couple. Well, I'll show you that you can use a trust to shield those assets, if you will. You can also consider paying tax now on accounts that you will need to draw in the future. Something that you definitely should consider. You can also utilize life insurance to offset the tax on your assets. We're going to go over that. So, let's first go over the most common strategy that if you think tax rates are going to go up, a Roth conversion strategy is something that you should definitely look into. One thing I will point out, is that people with higher 401k balances and IRA balances, well, a lot of times people that are over 1.5 million in those accounts, sometimes they look at it as, well, that's just a lot of work for hardly any benefit. But even the people with the high balances, if the tax rates were to go up and you pay the taxes now at a lower rate, you would have benefited yourself. So it's something that everybody should consider looking into if they have money in IRAs and 401ks. So basically what you do is that you're paying the tax now versus later. So in your IRAs and 401ks, you're paying that tax, and then you roll it into a Roth IRA. So basically, again, with a Roth IRA, it grows tax-free, and you can withdraw tax-free. So by going to a Roth account, you no longer have a tax lien on any of that portion of the money. And this, I highly recommend you look into, talk to a professional about this, because it can be very tricky. You want to do it the right way, and a lot of that is based on your tax bracket. So a lot of times when I'm helping people with this, we accomplish this in stages. and very seldom do we do it all at once. Does that make sense? Because what you're doing is you're adding to your income when you're doing this. So you have to do it the right way. If you convert too much, it could push you into a higher tax bracket, which is basically what we're trying to get out of in the first place. So basically what this does is it allows you to use today's tax, or excuse me, pay tax using today's rates. And this is very, very popular these days. So something you should consider, possibly looking into if you think tax rates might go up. The next concept we're going to go over is an A and B trust strategy. Now, several years ago, this was a very, very common concept because way back in the day, estates were taxed if you're over $600,000, which a lot of people out there are over $600,000 these days. Now, we don't know what, what that estate tax is going to fall to. Currently, again, it's at 11.7 as a single, 23.4 as a couple, but I have a feeling that's going to change dramatically. So what happens if it changes dramatically? Well, you can use this A and B trust strategy, and it's basically the use of a revocable trust which becomes irrevocable at your death. A married couple can shelter twice the normal amount of federal estate taxes also. So again, when you're considering this trust strategy, this is something that I highly recommend you look into contacting a qualified attorney, and I would highly recommend that. I could go over concepts with you individually, but you definitely want to consider it a qualified attorney by looking into this trust strategy. But again, we don't know what the state tax is going to fall to, but this is a strategy that you could use to shelter some of those assets, because we don't want to pay 40% in taxes if the state tax stays that high. So it's something you should consider if you have a high estate. Also, we can pay tax now versus later. So you could sell your investment assets now under current tax law rather than waiting for future rates, which they're talking about has a high possibility of being higher. So if you've got an individual stock, and you might want to pay the capital gains rate based on today's rates versus gambling on what they might be in the future. Does that make sense? The other thing, you can utilize life insurance. And this is very common with estate planning and that sort of, with the estate tax that we talked about, and another, it's basically a way that you can shelter assets from income taxes, because the cash value in life insurance, it can be accessible free of income taxes by using loans. Just take a loan off of your policy. Also, that death benefit, it's also paid most of the times with no income tax owed at all. So as tax rates go up, more people start to look to life insurance if their situation falls in certain categories. So life insurance is another way that we can, help the situation. If the estate tax drops crazy like it did in the past, like at $600,000, you could, use life insurance as another way to shield your assets from that estate taxation. So this is one thing that I hope you get. If you get anything, this is what I hope you gain from this presentation. Taxes are very likely to rise, and now is the time to act. If your current plan doesn't have a tax reduction strategy, then you don't have a holistic financial plan. You really don't. Because if you have a holistic financial plan, taxes need to be considered, especially if we think those tax rates are going to go up. So, this is the time to act if you think that the rates are possibly going to change. So, I want to give you an opportunity. If you want to learn more about how this affects you, I love to answer all of your specific questions. That's why I didn't have this as a live meeting, because I didn't want to have a lot of people asking questions and taking me down rabbit holes and that sort of thing. So if you want to learn more about how this might affect you, I would recommend you reach out to your current advisor that you're using. If you're not using an advisor and you'd want my help, you can do that in a bunch of different ways. When I sent you an email about this presentation, there was a link that you can click and you can, set up a time. We can talk over the phone, you can come in, whatever's convenient for you. I'd love to make that available to you. Also, another way that you can reach out to me is go to www.bookachatwithkd.com. You go to that website, you can click the same thing as the link that I was talking about in the email. You can click that you want a 15-minute call or however you want to meet with me. And this is a free consultation. I'd love to answer anyone's questions, because I have a feeling that tax rates are going to go up in the future. You're hearing about it in the news, in the media, everywhere. So if tax rates are going to go up in the future, then it would be in your best interest to consider making changes that will help your situation. So I hope that you all gained some valuable information in the presentation today. My whole goal was to just give this as an educational setting, and hopefully you can gain some information by it and help your individual situation. Again, my name is Kevin Daniel, and I hope you enjoyed today's presentation. I hope everyone stays safe out there, and if you have any questions, please reach out, because I would love to help. I hope everyone has a great day. Thanks again.